What happens when debt can't be repaid? Not for one person, not for one company, but for the system as a whole. When a bill comes due and the money to pay for it simply doesn't exist, today we're not asking whether debts can be repaid. We're asking who takes the loss and how it's hidden. Stay with me to find out more. Welcome to Grounded Finance. I'm not offering sensationalism. I'm just offering the uncomfortable truth behind the money. So for a system, paying it back is a bit of a category error. When an individual hits a wall, there are options: default, restructure, extend and pretend. Same for a business. But at the level of an entire economy, the language of paying it all back is a category error. Why? Because most money today is created as credit. So they're not real physical things. They're just something that's expanded to you by the system. Credit generally expands faster than base money, and the system generally requires something to roll over as a function. So let's set the stage with round numbers. Think about the money stock, call it all the dollars sloshing around on your bank account, then stack it against the claims on those dollars. So you can think about it as government debt, household debt, corporate debt, and offshore dollar claims as well. These claims will dwarf the base by tens, if not hundreds of multiples. Even if you pick your favorite data set and argue the exact figures, the direction is undeniable. There are more claims than money. So how did we, or more like the central planners, build towers of IOUs on small money base? Enter a boring word that drives everything, and more like jargon: rehypothecation. So how does rehypothecation work? So think about how $1 becomes many, many loans. Imagine if you deposit $1,000 in your bank. You still see $1,000 in your application or in your banking account. The bank buys a treasury as a part of it. Now the government sees dollars. The pensioner who receives the benefit deposit sees dollars as a part of the money that the government received from issuing the debt. The bank that holds the pension dollars now makes mortgage as part of that. Now the home buyer sees the dollar to buy the house. The same base dollar is supporting multiple simultaneous claims at the same time. So you can see how money is being created out of close to nothing. And no, this is not evil. It's the plumbing of modern finance. Money is essentially loaned into existence. Your deposit is someone else's loan. Their spending becomes another deposit, and around we go. In good times, this speeds up growth. In bad times, the loop runs in reverse, or it makes your life miserable. And it makes it miserable very quick, as we saw recently after COVID. You might say, fine, if the same dollars can support multiple loans, can't we just run the loop faster and pay everything down? In theory, yes, higher velocity can do a lot, but velocity itself can't solve the next piece of the puzzle. If you look at the data from the past few decades, interest rates are marching lower. That made servicing a given stock of debt cheaper every cycle. On a credit card, going from 20% to 10% pretty much doubles the principal that you can carry for the same payment. At 1%, you can get almost unlimited amount of money from your credit card because your payments will be very, very low. If you take an example from 2020, right, the rates bottomed and began to climb quickly. So that's an example pre-2020. Then 2020 happened. Rates bottomed and began to climb quickly. Suddenly, the world's most livid entities, such as governments, households, corporates, had to roll over their debts at higher coupons. Interest expense exploded. And because no one pays off sovereign principal, they refinance it. Higher coupons feed higher deficits, which feed larger issuance, which feed, you get it. It becomes a bit of a loop of higher and higher payments. We've shifted from a tailwind of falling rates to a headwind of increasing rates or stubbornly high rates. That flips the cycle from leveraging to deleveraging. And the hard truth is, there isn't enough money to retire all the claims cleanly. So the question isn't, will the debt be repaid? The question is, which channel will distribute the losses from this phenomenon? There are four main paths, or you can say four main cases, but we won't get a clean single path realistically. It will be a bit of a blend, but breaking them apart helps you see the mechanics and strategize your portfolio and also your wealth around it. So path number one is the nasty one. It's a restructuring of debt, either explicit or stealth. This is what you see in countries like Venezuela, Argentina, or Greece. A debt jubilee or restructuring of debt is the oldest trick in the political economy book and also in potentially personal finance as well. Sometimes it's explicit, loan forgiveness for a targeted group. Sometimes it's stealth. So the central bank can buy the government's bond and remits the interest back to the treasury. The second case is more like the left pocket pays the right pocket. After expenses, it's pretty much netted out. Functionally, that turns into a chunk of public debt with zero interest and perpetual liability, like we see in the US at the moment. The next question is, could a central bank backstop huge portions of the sovereign curve if forced sellers appear? History says, if necessary, yes. And that's not a conspiracy. It's written into the crisis playbook. And the catch is credibility. The more you do this, the more you flirt with the next path. So in simple terms, some debts can be really forgiven openly in small pockets and implicitly at some sovereign level. Someone else then eats the cost by a currency debasement or foregone returns. Path number two is a bit of a nasty one. So it's a deflationary deleveraging, or it could be a death spiral. This is the outcome that everyone says policymakers won't allow, which is exactly why you should size it as a risk. Defaults destroy deposits, destroy enough deposits, and you destroy spending. Destroy enough spending, and more borrowers will miss payment. Lenders mark down assets, and the capital ratios start to crack. When a bank fails, its money ceases to exist, and the spiral tightens essentially. Speaking about deflation, prices of assets and goods collapse not because they changed, but because the money side of the pair got scarce. This is brutal, fast, and if allowed to complete, surprisingly cleansing. It replaces the political pain with economic pain. Historically rare in modern flat regimes, but I wouldn't say this is impossible. So in simple terms, deflation may sound like nirvana in the first year or two because your cash would buy more for a while, but your job and your portfolio may not survive the journey, essentially creating wealth destruction for everyone. Path number three to me is the base case for our future. It's inflationary deleveraging. So it's pretty much the money printing, and asset price will go to the moon and dollar goes to the bottom. Yeah, as I mentioned before, this is the base case for myself and what most analysts would prefer. When a hole appears, the central bank prints a plug. A bank tips over, then we just guarantee deposit. If a market freezes, then we create a facility. And if a government's coupons threaten the budget, the central bank will just buy the bonds. Debt still gets reduced, theoretically. Companies cut, households sell, government debt still gets reduced. For example, companies will cut, households will sell, governments will trim, but the money stock rises to cushion the fall. That means prices will drift higher and higher and higher over time as the real economy wobbles, because you're spreading the losses across all holders of the currency. It's a stealth default by making the real value of money lower. It feels kinder than path two, but it taxes savers quietly and continually. If you ask me why this is the base case, if you look at the stories around you from even FinTwit to mainstream media, the narrative from world leaders is about pushing interest rates lower and causing more inflationary pressure to the economy, although we are already sitting at a relatively high inflation, and it doesn't seem like the disinflation will continue at this point. So in simple terms, for this case, the nominal numbers will go up, everything will become more expensive. Real purchasing power doesn't. Real purchasing power will just go down. So your dollar doesn't really go as far. Long duration of fixed income bleeds in real term, and anything with pricing power will pretty much leverage that to the maximum. Path number 4 is a bit of a nirvana. So this is the productive boom. So we can grow ourselves out of the debt. So I would say this is the optimistic path, or the nirvana, if you'd like to call it that way. So if you borrow $10,000 for a skill, land a $100,000 job, and even after debt service, you're still ahead. Societies can do this too. So for example, if we invent new energy sources, innovative technologies, efficient processes, this will make productivity jump, lifting income faster than the debt service. We've seen it before in the agricultural revolution, the industrial revolution, and the internet. But the question is, can we do it again this time from this starting point? The question is maybe. There are a few innovations coming through, but we still don't know yet about what that innovation will bring to our economy. Think about AI as a big one, biotechnology is still in the early stage, new materials, energy storage, so we still have a runway. But booms take time, and interest expense is compounding now. And we also have uncertainty on how much this innovation will bring to the economy. Betting solely on this path is a bit of a leap of faith, but ignoring it is a mistake, or more like a depressing case. In simple terms, this is the only path that avoids spreading losses. So everyone gets more prosperous, everyone's purchasing power goes up because it creates a new surplus and a new way to create productivity in the economy. But it's also the least controllable by the policymakers because it relies on entrepreneurs to make this happen. I'm going to talk about the hidden fifth path, which is not really talked about. It's called financial repression. This is a contrarian add-on to most mainstream takes, and most mainstream media will underplay this. So it's called financial repression because it's not a separate path. It's more of a wrapper or packaging around the others. It's how you force the system to absorb the losses without causing significant riots or unrest in the society. So what does repression look like? Think about caps on deposit rates while inflation runs hot. Safe asset rules that funnel pensions, insurers, and banks into government bonds at yield below inflation that give you negative real returns. Tax tweaks could make holding cash painful and long bonds prudent. In plain English, your savings and retirements are conscripted to fund the state at a loss in real terms. If you remember recent examples, in 2021 to 2022, rates remain low while inflation is running really hot, although government eventually catches up with the rates. This is a classic example of financial repression. So who eats the loss based on these 4 paths? So we've established that the losses will not vanish, but one thing that's not clear enough, who will the loss be assigned to? In path 1, where we talk about restructure, pretty much the creditors and the currency holders eat the losses. In path 2, the debtors and the weak lenders eat it quickly, and unemployment rates will skyrocket, and therefore everyday people like you and me will pretty much eat it. Path 3, which is more inflationary, everyone holding currency or fixed income will eat it slowly, although over time, people in general will feel the pressure of the inflation. In path 4, where productivity skyrockets, no one eats it. The surplus will pay the tab, although this is again a bit of a nirvana. And repression from the central planners will ensure the right mouths are forced open at the right time. So pretty much the elite will benefit regardless of the path. So in summary, you might not get to choose the menu as a central planner, but you can choose whether you're the entree. So enough with the press talking. How do you position yourself in this situation based on the different paths? Remember that this is not going to be like one single path independent of each other. there will be like a mix of different paths or a sequence of the paths depending on how the world moves. So think about this like scenarios and the mix of scenarios. If deflation bites, so if we're thinking about path 2, cash and short duration bills matter. So you might want to funnel more of your money into T-bills because the dry powder that you save will buy distressed assets and you can profit a lot from it. Think about cash and liquidity like oxygen. You may be impacted by job losses too. Companies will cut prices and demand will sink. If you have cash, you will be in a prime position to buy undervalued assets and put yourself in a safe position as well, generally. In path 3, where inflation dominates, you need to avoid relying on nominal coupons or any bonds for real returns. You need to go to cash generating business with pricing power and low refinancing needs. Consider also real assets or commodities such as gold, real estate as insurance, as these commodities tend to do well too, as we've seen from 2021 to 2024. If repression ramps, you have to be cautious about being the captive buyer. Watch for prudential rule changes that turn voluntary holdings into mandatory allocations. In this scenario, try to broaden to overseas markets or companies with access to global markets, so you don't get captured in a depressed home market. If you're going to path 4, where productivity surprises, you have to be open to selectively funding real innovation. So for example, for AI, NVIDIA was a good case where people are running ahead of the innovation. But remember, narrative can run ahead of cash flow. In this case, focusing on narrative and allocation on a hypergrowth company is very important, as it will generate an outsized return. If you miss the hypergrowth company, don't worry. Think about the companies that can provide the picks and shovels for the hypergrowth narrative. This is the second layer of growth that you can tap into. To help you allocate where you put your wealth into, think like a barbell or more like a seesaw, pairing safe liquidity on one end with resilient cash-rich assets on the other, and keeping the squishy rate-sensitive middle small. You can always adjust the weight on each side of the barbell based on your thesis or narrative. For example, in a deflationary environment, you may want to keep more assets and less risky companies. And on the other hand, when it's inflationary or when you have a productivity boom, you may want to put more risk on the middle and the risky end of the barbell while keeping cash flow, just to make sure you maintain your purchasing power and wealth. And this is the uncomfortable takeaway. The era of don't worry, sovereigns never have to repay missed the point. Exactly because they don't have to repay, the real game is choosing how they want. The choice isn't moral, it's mechanical. Mechanics collide with politics. The path of least resistance is to spread the pain quietly over the years through inflation and repression, with a sprinkle of micro jubilees or micro restructuring to keep the crowd calm. So ask yourself these 2 questions. If my wealth were the balancing item in the system, how would I know? If I'm wrong about the path that the government is taking or the system is taking, what survives across the others? So that's the mindset that we have to take. Assume that the system will do what it must, not what it promises. Position so you're hard to kill in the bad parts and still alive to enjoy the good parts. If this helped reframe your thinking about the sovereign debt, please let me know, and let me know if you think otherwise or if you have an alternative opinion of this. In the comments, also tell me which path you think we're on and what you're preparing for in the future. I'm very curious about what you're preparing for as well.